Hello, good afternoon, and a very warm welcome to you all. Thank you for joining us for this, the final BKL webinar of 2018, I'm sad to say, but I'm delighted to say I'm joined by a crack team of tax consultants today. We have the overwhelming sheer intellectual weight of 5 of my fellow members of the BKL tax consultancy team. So we have Adrian Thomas, good
Hi.
afternoon. We have Geraint.
Good afternoon.
We have David.
Hello.
We have Dougie.
Hello there.
And finally, but not at all least, Andrew Levine.
Hi there.
So we're going to have a quick tour through the latest budget. Many of these announcements had previously been trailed, so there weren't, I think, too many surprises in there, but we'll see what little nuances we can dig out of that. We do very much invite your questions as always. Particularly today, this is really meant to be a sort of round table discussion, so any questions, please do type them in a normal time-honoured fashion, and we'll see what we can do between us all to give you an honest and, if not witty, answer to them. So we'll make a start, if we may. What are we going to cover today, then? Well, first of all, we thought worth just mentioning what the Chancellor didn't mention in this budget. There were some doom and gloom predictions, all linked to Brexit, etc., etc. There were fears he was going to reduce the VAT threshold. That remains at £85,000 until at least March 2022, so some good news there. And he didn't increase income tax or NIC. I know in the past there's been controversy when he's tried to keep income tax rates fixed but raise NIC. He left well alone this time. Entrepreneurs relief, big sigh of relief at first there, because that stays, but there were some changes, and perhaps changes that were slightly more significant than many people first realised, that we'll look at in more detail sooner. And he even found £420 million to fix a few holes in the road. So as a start, not bad, wouldn't we all say? Was there anything else, gentlemen, we were expecting to see that wasn't covered in there? No, we'll take that as a no. Okay, so
There were things I was expecting not to see in there, and which I don't expect to see until March or April, when the Inland Revenue can sneak anything in that's not going to get any public scrutiny while the attention is on Brexit. But probably not headline rates.
yeah, such as?
Oh, the specifics of it, I don't know.
Yeah.
But anything they've got a grievance about, they've got an attention to put anything into the Finance Act, and no one's going to pay attention to it.
All right, well, we shall wait and see. So what are we going to cover in the next 45 minutes or so? Well, we'll look at some of the property changes. They could be substantial. I'm delighted to say we've got our property expert, Andrew, here to talk us through those. We'll look at those sneaky little changes to entrepreneurs relief that we mentioned before. A few changes to capital allowances, generally welcome, but as always, the odd sting in the tail. Some tweaks to the intangible assets regime, a long overdue reform there. Some restrictions potentially in the future on R&D, and then Doug's going to end off by talking us through the changes to contracting and freelancing, again somewhat of an extension of changes we've seen in the past. So that's what we'll cover, but as we say, any questions, do please type them in. So let's start with property, Andrew, if we may. We've had CGT for non-residents for a little while. When was that first introduced, gentlemen? Remind me. 2015. We here.
2013.
So this has been a long time coming. So we've had CGT on residential property for non-residents, but this has been extended. Andrew, do you want to talk us through the main changes there?
Okay, well, obviously the main change is that firstly, capital gains tax for non-residents is being extended to commercial property as well as residential property. But the other big change is that it's not just going to apply to direct disposals of property, it will also apply to indirect disposals of properties. So that is where you sell shares in what is commonly referred to as a land-rich company. How they're defining that, the definition of what they say is a land-rich company is one which derives 75% or more of its gross value from UK land.
So when do we apply that test, Andrew?
Well, as far as I can see from the draft legislation, the test is only applied at the date of disposal, which in some ways is a bit curious, really, because it means you could have a company which has always owned land, and then just immediately before sale, you put a whole load of cash in the company, And at that point, it appears no longer to derive 75% or more of its value from land. There's nothing specific that stops that, although there is, as always, a targeted anti-avoidance rule in the legislation, and I think that is wide enough to stop that. But in some ways, it is a bit curious that they're relying on a TAR to stop what is a rather obvious loophole.
Okay, now these rules on property-rich companies, does that only apply if it's commercial property? Will they also have this look-through for residential properties?
No, it's everything. So for non-residents now, for capital gains tax purposes at least, there is no longer any distinction between residential property and commercial property. As with UK residents, of course, the rates will be different, but they are both equally as chargeable, and that applies equally to land-rich companies as well.
Okay,
Andrew, I mean, there's a bit of a gotcha here, isn't there? Because if you sell shares in a company that's a wrapper for a property, you're paying tax on the gain, but you're not getting any uplift in the shares within the company. So that if the shares are sold by the buyer again and again, through a chain of buyers, you've got a tax charge each time, but you still got the original base cost.
Yeah. Well, I mean, this of course is the double capital gains charge, which we're all familiar with when we sell a company which has got a property in, and you and I as UK residents, we have that particular problem. So I suppose you could argue that it's not entirely unfair that a non-resident should have that as well. One thing that's worth adding about the draft legislation as it stands at the moment, they haven't included the special rules that are going to apply where a collective investment scheme holds a property. And what they have said is that there is effectively going to be a transparency election for collective investment schemes, which I think will avoid the issue you're talking about. So that's only going to apply to property investment schemes. I think if a non-resident just holds shares in a land-rich company in the same way as you or I may hold shares in a company, then I think they're going to have the double capital gains charge issue in the same way as we do.
And often they will want to sell the property out of the company so that they've got cash and then have a dividend without withholding tax.
Yeah, on the face, I mean, every case has to be looked at on its merits, but on the face of it, that would probably seem to be a sensible thing to do.
Okay, so these rules subject to finalisation.
Yeah, I mean, because they haven't included the collective investment scheme rules, my guess is that I think when they finalise them, there will be further changes because, as I've said, I think there are some anomalies in the rules at the moment, and I suspect those will be tidied up.
Okay, thank you for that, Andrew. Now, there's also further bad news, isn't there? There's potential stamp duty changes here as well.
Yeah, no detail on that. They've said that's coming in January next year. We should get some detail. At the moment, I mean, the proposal is to charge an additional 1% stamp duty for non-residents buying UK property. I mean, at the moment, while we're still in the EU, that of course is illegal.
Agreed.
But from March or whenever they extend to, then all things are open, I guess.
Okay.
So watch the space.
Watch this space. Okay, thank you for that. So those are the extensions to CGT for non-residents. It's also proposed that going forward, CGT will have to be paid within 30 days. And I think that applies from 2020, as we've said on the slide, not just for UK residents where that rule has been introduced. So that probably moves us on over to you, Geraint, because there's also been some changes that affect home ownership. Some good news, some bad news here. Do you want to break it to us all gently, as it were?
Absolutely, yes. Well, the capital gains tax main residence relief is yet again being slowly eroded away. As you'll no doubt all be aware, there was originally back many moons a 36-month, was it, exemption on well, kind of additional main residence relief for any property that had been your main residence. That then got reduced down to 18 months, and now it's going down to 9 months.
Just out of historic interest, wasn't it originally 12 months to deal with the properties in Docklands?
When CGT originally came, when the relief was originally came out, the exemption was, I can't remember what it was, 12 months or 18 months, but it again got increased to 36 months.
Because of the Docklands.
Because of delays in selling properties. but 9 months, I think I'm right in saying, is the shortest it's ever been.
Yes, and clearly a fundraising exercise. And to be honest, it was always quite a generous relief anyway. But I will still lament its gradual demise. The other big issue on the main residence is what looks like the end for most of us of lettings relief, which is 40,000 up to £40,000 on the gain if the property has been your main residence and has been let as well. Exactly why they're doing this isn't altogether clear, but they're talking about a shared occupancy with a tenant rule here, and it's not immediately clear what they're getting at. So you would have thought that you'd have got a CGT relief anyway if you were living in the property and just renting out a room.
You know, I think Adrian made the point that it would, as drafted, would seem to apply only in a circumstance where you are in shared occupancy of a property that is not your main residence, which is such a peculiar and unusual set of circumstances.
I also suspect they're just trying to draw the net round the army of buy-to-let landlords who just pretend it's main residence, tick the form in, and things don't get scrutinised. So they're just saying, look, you couldn't have known you weren't liable.
Yeah. Apropos main residence, of course, the revenue are increasingly looking at the tests for a property being a residence at all. And there was a recent case that was, as a brass tacks on yesterday on the YECL, which looked at the quality of residence. And I think you, Andrew, said that the moral of that is to make sure you do your own washing. But increasingly, residence at all is the revenue I seem to be tightening down on the relief.
I mean, I
did have one client who sold a main residence, bought a couple of cottages in Cornwall on opposite sides of the road, used one as a main residence for 6 weeks until the wife decided she wanted the light coming through different windows, and they moved to the next one, and they got main residence on both of those as well, much to my surprise.
Okay, right, thank you. So a bit of tightening up on CGT and main residence, and as David's referred, there's been some case law that has highlighted the need for not just putting a sleeping bag down, but true quality of occupation. We had the Google tax. We also had the proposed Airbnb tax, didn't we? There's some good news here, right?
Indeed, yes. Yeah. There was another one of these shared occupancy tests was mooted here, whereby you actually had to be with the Airbnb tenant at some point during his stay to qualify. If you recall, due to a kind of loophole in the legislation, somebody could actually be abroad or go on holiday and rent out the property whilst they weren't there and claim rent-a-room relief. And that was never really the intention of rent-a-room relief. It was to rent out a spare room in your house or your flat, not rent out your flat whilst you were on holiday.
Yeah, I think the point was made. If you were lucky enough to live within a stone's throw of Wimbledon or similar, you would move out for 2 weeks and charge an exorbitant rate of rent, and that would also, much to my surprise, I'd have to admit, be covered by the rent-a-room scheme. That was never really the intention. But they've rowed back here, haven't they?
They have indeed. So the shared occupancy test has now been removed. So I don't think we're a great deal away from where we were originally in the rent-a-room. It's £7,250 exemption. And it's still a very generous exemption if you want to share your home with somebody.
Or two nights at Wimbledon, I think.
Is that per family, or can a husband and wife each have it?
I think if they're joint owners of the property, they get £3,750 each.
Yeah, that's right.
Yeah.
That's right. Okay, so I think let's move on now, unless no questions so far on that, to possibly the main topic we need to talk about today, which is entrepreneurs relief. As we say, we're a bit of a sigh of relief. We're all concerned this could be significantly reduced. Entrepreneurs relief continues, but there have been a couple of important tests. David, do you want to talk us through those?
Well, hitherto, of course, in looking at whether a company is a family company, personal company rather, the test has been that you possess 5% of the ordinary share capital and 5% of the voting rights. Now that has been, I was going to say abused, imaginatively interpreted, particularly where there's perhaps an MBO or where a company is acquired, so as to afford 5% of the voting rights to a shareholder, but without giving 5% of the economic value of the company. So there might be no rights to dividends, no rights to capital, but nonetheless 5% of the voting rights, and that's has hitherto been qualified for entrepreneurs relief. Now, what's now proposed and what's in the finance bill is a provision requiring you to have not only 5% of voting rights, but also broadly 5% of equity rights. So at least 5% of any dividends that are distributed and 5% of any capital distributed in a winding up. Now, the difficulty with it is that it's not about physically having, as a matter of fact, 5% of dividends that are distributed, but having the beneficial entitlement to 5% of dividends that are distributed. And I think there are two circumstances in which that possibly becomes problematic. One of them is in regard to alphabet shares, where there are different classes of shares, but there is discretion to vote dividends on each class of shares, so that no class of share has an absolute right to receive any dividends. Arguably, none of those alphabet shares would qualify for entrepreneurs relief at all, even though they might in fact get 5% of dividends. They would not have a beneficial entitlement to 5% of dividends. The other category of share that might cause difficulty is where you have shares with a fixed right to dividend, but which are nonetheless ordinary capital. So particularly where you've got venture capital investment into companies, where venture capitalists might put in equity on terms either that there's a preferential right to a fixed slice of dividend, or to a fixed amount on a winding up of the company, and that might have the result that the other shareholders, the other ordinary shareholders, might then drop below 5%. They might get more than 5% of what's left for the other ordinary shareholders, but that might not be 5% of the total amounts distributable or of assets. So those fixed dividend or fixed capital rights might also screw up what ought, on any analysis, to be shares that qualify for entrepreneurs relief.
Yes, and if there's a problem, we had the problem on the 29th of October. So the best that we can do is to rectify a situation going forward and start a new 2-year clock.
And that's the other important change, of course, that the qualifying period is now to be 2 years rather than 1 year. So as you say, Adrian, if the shares cease to qualify, then they will. Even if we change things to make them qualify, we've got to wait 2 years before they get the relief.
Now, go on, Adrian.
On one of the areas that you're talking about, just the a fund investing into a company and having a prior slice of dividends. One that I was looking at just a couple of days ago, they haven't yet made the investment, and the simple tweak is, instead of just saying there's a preferred dividend on the A shares of 350,000, there is also a preferred dividend to my main chap of 20,000.
Yeah, the other way of doing it would be to instead of attaching a preferential right to ordinary shares held by venture capitalists, is to give venture capitalists ordinary shares that don't have a preferential right, and then create separately a preference share that doesn't have the qualities to make it an ordinary share, and then that wouldn't be on the face of it it wouldn't cause a problem.
Okay, so 2 issues you flagged up there. What are we going to do, Adrian, about, you've got the A shares, I've got the B shares, this is a company we run jointly, but the shares rank pari passu but have a separate entitlement to dividends?
Well, I think you're going to have to look at every case, because it depends who's important, how fragmented the shareholdings are, and the size of each shareholding. One case I was just dealing with a couple of days ago, there were 6 classes of shares. 4 of them are held in trust, so they're not going to get ER anyway. So I'm left with a a 60% and a 10% shareholding where it matters. And I've said that the A shareholder gets 5% of any dividend,
Right.
as a
Mhm.
limit on the director's discretion to pay dividends on different classes, and similarly on the C shares. But the other fix in many husband and wife situations is to say, you know what, we know roughly what kind of income we're drawing out, we know roughly how we want to split it. So we're going to collapse shares into ordinary shares and hold them in the right proportions.
Yeah, and we'll come on to that perhaps a little bit more in a second.
What is interesting is that in the tax impact information note, that's meant to be a briefing, A, to the Cabinet and B, to Parliament, to show that a measure is worth doing. So it's supposed to quantify its impact on the Treasury and on taxpayers who are affected. They said that 1,000 people will be affected, I think, over a 5-year period. So they were doing their numbers on the basis of 200 people a year with a £500,000 gain. That gives them the 10 million a year yield they were expecting to get from this change. And I think the change is so disruptive to business, it's not a good change to make for the sake of 10 million a year. And if the revenue were planning to gain a lot more, because I mean BKL alone has 1,000 taxpayers affected by this change, I think, that they're not playing fair with Parliament or the Cabinet.
So do we think this is actually one of those sort of unexpected tweaks that even the revenue didn't quite realise what they were doing?
That would be the nicest interpretation. That it was an honest screw up.
Yeah. Andrew, did you want to add something?
Is there any chance, do you think, that they'll change it?
Well, people have been saying, hang on, this creates a huge problem. And when people have been trying to get onto the inland revenue, they just say, go read the book.
And even if they don't change for alphabet shares, it sounds like they ought to do something for the more commercial situation that you mentioned, David. That seems to be something that perhaps we could make representations on.
I think fairly robust representations are being made to the revenue on the changes generally. I mean, I think part of the evidence for it not having been thought through terribly carefully is the fact that the draft entrepreneurs relief legislation imports wholesale some definitions from the the Corporation Act 2010, which legislation was designed to deal with group relief, and it doesn't really fit into the capital gains tax code, and it needs to be hammered into it's round legislation that needs to be hammered into a square hole in the capital gains tax code. So the evidence is it's not been terribly well considered.
Yeah. But leaving aside jurisprudence and good tax management, the tax law aspects of it, where we are now is no one's going to spend time looking at the problem of people who had funny classes of shares, who are playing with fire, who got burnt when all the attention is on Brexit. So I just can't see it getting on anyone's radar for a fix.
Look, I think it would be fair to say that HMRC have never liked alphabet shares, and we focus very much on the impact for entrepreneurs relief. And the one point I would add is, and you guys will correct me if I'm wrong, you qualify if this is your personal company, and that test is applied to all of your holdings. So if you had ordinary shares and alphabet shares, the fact that those alphabet shares may not meet this new test doesn't preclude you from getting the benefit of entrepreneurs relief, I think. Is that correct? Anyone going to contradict me there? Because it would be your personal company by virtue of the ordinary shares you hold. So we'll need to look at that as a possible solution as well.
I think I might actually take issue with
Well,
because if there are both ordinary shares and alphabet shares, then the very existence of the alphabet shares with a discretionary right to dividend arguably means that even if you've got 50% of the ordinary shares, you're not necessarily beneficially entitled to 5% of the dividends that are voted, because the dividends might all be voted on somebody else's Alphabet
No,
shares.
to be fair, I
Is
see your
the
point.
idea, David, that any time a dividend is voted, the 5% share would always get the 5% dividend?
Yes.
Yes.
And then in which case, then
Yeah, well, that's fine if the share has the entitlement to it.
Yeah.
Yeah.
But
So
I mean, that's how it
that's
has to work, isn't it?
Adrian's
Yeah.
that's Adrian's solution. I think, I
But
think
we,
it works.
we have to make it a legal right, not just what we're actually doing.
Exactly.
So, I mean, you know, we're trying to suck out from our company secretarial database everybody that we know of with more than one share class. And I think every firm needs to do that so that they know who's got a problem to be addressed. The second thing, I come across many companies that I've inherited from other firms where they've never really put things in the articles. There's some half-assed notice of allotment that's had scribbled on it some special rights of the shares. And that wants to be tidied up so that you know what your starting point is.
All right, so there's certainly work to be done here to tidy up the rights attaching to these Alphabet shares if you wish to become, once again, qualifying for the purposes of entrepreneurs relief. But the point you made, David, was the clock has been restarted and it's now a 2-year clock because this change came into effect on budget date, whereas the 2-year holding period only applies for disposals after the 5th of April next year.
Correct.
Okay, so that's where we are.
Well, it's actually got a look back period. If you had shares that didn't ensure someone had 5% at any time after 5th April 2017, then on a disposal, you look back 2 years from the disposal and you say, well, it hasn't been your personal company throughout that period.
Yeah.
So.
All right, so there's work to be done. I think that's a very important point. Just to illustrate it, a couple of quick questions here. So Michael asks, you've got Alphabet shares. If you change them all to be ordinary shares, the 2-year clock starts from the date of reclassification. I think that's the point we're making, isn't it?
Exactly.
So absolutely. And David, I'm delighted to say, is back from the golf course. Hope you had a nice time, David. If all classes of shares had the right to receive 5% of dividends, but when the dividends are voted, the shares with a 5% right did not have any dividend actually voted, would that disqualify the holding? I think he's saying, although they had an entitlement, they didn't actually receive that dividend, or they waived it.
Oh no, take it and make gifts out of the net income.
Yeah, I think I'd be worried about. I'd be worried about whether the article. I mean, bear in mind the article of association are essentially a contract between the shareholders, and if the written contract between the shareholders clearly hasn't been acted on and nobody intended to act on it, it calls into question whether it was a valid contract in the first place. You know, shams and all the rest of it.
Even if there was a valid dividend waiver.
Well, as I say, if habitually the dividend is waived and it becomes evident that nobody ever intended those shares to get 5% of the dividends, then I think I would be nervous about arguing that dividend right was ever actually intended to be a real right. Now, a one-off waiver every now and then would be different, but I think it's far safer, as Adrian says, if the shares are entitled to at least 5% of the dividends, then to give them 5% of the dividends. But try not to have more than 20 shares. That are entitled to.
And you're also going to have some tax officer doing a simple check. So in the last 2 years, what dividends have been paid? Who got what?
Yeah, and all sucked up by their supercomputer, no doubt, and analysed accordingly. Look, I think the message is be very, very careful in such circumstances. Okay, so clearly work to be done there. And these changes, as I say, I think are going to be far more wide-reaching than most of us, I think, realised at the time of the budget. So we've highlighted 2 changes there. 1, you've got to have sort of more substance in your 5% holding. 2, the minimum holding period for entrepreneurs relief is going up from 1 to 2 years. So bad news, but there was a little bit of light relief within these provisions, David.
Yes, this was jolly good news. This is relief. This is a provision that says that if, as a result of a fresh issue of shares for cash for bona fide commercial reasons, so typically taking in a tranche of finance to develop the business or venture capital money coming into the business, if a company raises cash bona fide commercial reasons, as a result of that, your shareholding is diluted down below 5%. Then, until this provision came into force, then you simply lost your entrepreneurs relief. And what this provision proposes is that you will be able, where that happens, where you are diluted down by a fresh issue of shares for cash, to elect to have a deemed disposal of your shares at a point, or immediately before they cease to qualify. So a deemed disposal which does qualify for entrepreneurs relief. And furthermore, you can also elect for that deemed disposal not to be recognised, or at least the gain not to be recognised, until there is an actual disposal of the shares at some future date. I can't really see why you'd want to make the first election without the second election, but so it's a very useful and sensible provision.
So you're sort of banking your 10% up to the market value now, but future growth you won't benefit from entrepreneurs relief.
Yeah.
All right. Now you kept stressing there this had to be a new subscription for cash.
Yes.
So if there's a debt for equity swap.
Well, I suppose a debt for equity swap, you could make a subscription for cash by actually repaying the debt and having the cash used. What it wouldn't apply is if you were, for example, being diluted because your company had acquired shares in another company and issued shares in consideration. That would not be a dilution that would qualify. It's always been the case, of course, that it's constantly been, the concern has been expressed on a number of occasions that if you have if you're a shareholder in a company and there are options in existence in that company, and those options are exercised immediately ahead of a sale, and as a result of the options you get diluted down below 5%, what is there a problem there? But happily, the Revenue confirmed many years ago that their practice in that circumstance is not to deny you the entrepreneurs relief.
Which was slightly odd, really, wasn't it? Because I think on a strict reading of the law, at that very point in time you sell your shares, you do not have 5%. So,
well, actually, even more interesting than that, on EMI, you could have 30% of the ordinary share capital and a right to subscribe for the rest, or to drown out, and the Revenue would say, well, so long as those shares aren't in existence, they don't count for the 30% test, which was always struck me as being extraordinary position for them to take.
But it's jolly good to have some good news on entrepreneurs.
And there's more. There's more, isn't there, David? On aggregation of holding periods, I think you'll find. Mr. Wiscombe.
That period. Yeah. It's very, no, that's I mean, it's very interesting. It's a very interesting provision because I think everybody. I'll be honest with you. I think everybody assumed that provision had been there from the outset. It's absolutely absurd to suppose that you run a company, you run a business as a sole trader for 20 years, you then incorporate it and sell the shares 6 months later. That why would you not get entrepreneurs relief on the disposal of those shares? Because you run the business for the qualifying period. And I mean, I've never actually encountered it in practice before. I've never encountered the situation. But I think if anybody had asked me beforehand, I would have thought, without looking at too much of the legislation, I'd have assumed you got the entrepreneurs relief anyway. But in fact, you wouldn't.
Well,
but you do now.
Until recent years, what you would have done, you'd have taken your company, you'd have sold it to offshore company and bank your capital gain. I can remember a few situations where we've done that.
But it's a provision that frankly should always have been there.
But it's the same as when you do a share for share exchange, isn't it? It's only by concession that the Revenue look to the previous company ownership.
Well, I'm not sure it is concession, because there was a the question was asked by either ICAEW or the Institute of Tax, I forget which, as to how entrepreneurs relief worked on a share for share exchange, and I'm not sure it's concessional because the legislation deems the new shares to have been held for the same period of time as the old shares were held. So that deeming applies for entrepreneurs relief.
Yeah, it's not entirely clear, the legislation, I think it'd be fair to say. So some clarification might be helpful.
But this is good.
This is good. Okay, we like good. Okay. Right, a quick question. Is there not an element of retrospection in the new ER rules if a business ceased to trade in, say, September 18 with a view to liquidation within 3 years?
Yes, you're okay. Yes, in that case, the new 5% rule doesn't hit you.
Okay. Thanks, John, for your question. Right. So that's entrepreneurs relief. Plenty to think about there. Let's move on, if we may, back to our erstwhile property expert, Mr. Andrew Levine. Another bit of welcome news, in fact, I think we'll find.
Yeah, this is also good news. A new structures and buildings allowance, which is 2% a year for the cost of constructing commercial buildings. It also applies to altering or converting existing buildings, but only where the expenditure is incurred on or after 29th of October. So when I first heard about this, the headline rate is only 2% a year. At first, I wasn't too excited about it, but when you actually do the numbers, because it's 2% on what is normally quite a substantial capital cost, it's actually quite a significant relief. So I don't think people should be put off by the headline rate. I think it is certainly worth looking at. The other thing, when I first saw it, I sort of thought, oh, this looks like the old IBAs all over again. And the rate is obviously the same, but there are some significant differences. Firstly, there's no facility for disclaiming allowances in the way you can normally. I think under this SBA, either you claim them or you don't. If you don't claim them, then you just lose them. There's also no system for balancing charges and balancing allowances, as with other allowances. When you sell a building, the purchaser just carries on claiming the unclaimed allowances. So at first blush, you might think that that means there's no actual clawback of allowances, but in the technical note issued by HMRC, it says that there is going to be an adjustment for the allowances claimed to the capital gains base cost. So my reading of that is that there is in fact a clawback, but the clawback is actually through the capital gains system and not through the income tax system, which means for an individual owning a building, he effectively gets the allowances at income tax rates, but the clawback then hopefully is at the capital gains rates. And it also presumably opens up the possibility that the clawback may be eligible for reliefs like rollover relief. So overall, I think quite a welcome relief.
When I costed this with a certain property group, I think I made the point that what's going to be important is the cost of capital and the price that a buyer in 5 or 10 years' time will put on the 2% allowance. And if you look at what people generally might be using as their discount rate for discounting a cash flow over 50 years, maybe the allowances are worth a couple of percent.
Okay, but all welcome, I think we'll say, subject to consultation, of course, this, so we'll have to see the fine details in due course. Mr. Wiscombe.
One of the questions arising here is who exactly gets this relief? What expenditure qualifies for it? And I think my understanding of the draft legislation is that it applies in respect of expenditure under contracts that are entered into on or after 29th of October. So I think I'm right in saying, you might comment on this, Andrew, that if a contract has been entered into before 29th of October, but the expenditure is actually incurred under that contract after the 29th of October, then you don't get relief.
You don't get it.
You don't get relief. So it's not simply incurring expenditure after the date.
No,
it's
correct.
it's contract
it's
before
new
the date.
expenditure.
Yeah.
But you can cancel an old contract and enter a new one?
No, I think they've put some provisions in about that as well.
Okay.
They're completely alert to it now.
And are we clear if, I build a commercial property and then grant a 999-year lease, who retains the entitlement to the allowances in that case? Is it the freeholder?
Well, we don't have any draft legislation yet. This is just a technical note. But what they have said is that if you grant a lease where the substance is in effect that you're selling the building, then the lessee will get the allowances.
Okay,
but
thank
in
you.
normal circumstances, it says that both the freeholder and the lessee can claim allowances on whatever expenditure they incur.
Okay.
So on a normal lease, yes, you would both be able to claim.
Okay, but generally good news there. Yeah, so one to look out for. Okay, some other, I keep saying it, don't I? Good news. Well, a bit of a mix here on capital allowances generally. The annual investment allowance, that's going up to a very generous How much is it? £1 million from January until 31st December 2020. So £1 million of expenditure each year on qualifying plant machinery, whether in the general pool, special rate pool, excluding the usual things like cars, etc., full write-off. So that may be very, very valuable. The quid pro quo here is that the rate of capital allowances for integral features, long life assets, anything that gets thrown into that special rate pool goes down from already fairly miserly 8% to an even more miserly 6%, I'm afraid. But incur your expenditure in the next 2 calendar years and you'll get full write-off via the annual investment allowance. So I think the point is there, do time your deductions, or sorry, your capital expenditure, so as to ensure major projects are incurred in that 2-year window. One sad exception to that is partnerships with one or more corporate partners, unfortunately. So I don't think we've ever quite seen the fairness of that, but that is a significant and somewhat unwelcome exclusion. Right. On to intangible assets. Now, this was always a bit of a fairly inequitable piece of law here. Do you want to talk about this, or should I, David?
You're doing so well.
Oh, I knew you'd say that. Okay, so help me out here, David. So the principle was, we've always had the substantial shareholding exemption, and that regime allows for the tax-free disposal of subsidiaries. And in, I think it was 2011, wasn't it, they changed the way exit charges were calculated. This is where a company acquires an asset intra-group in the previous 6 years and is then sold outside the group. There's a deemed disposal and reacquisition at market value. And this was to stop some very naughty so-called envelope schemes to allow you to snaffle assets outside the group without crystallising capital gain. But as in many cases, it did catch fairly innocent transactions. So these exit charges could potentially arise when a company was sold outside the group. We now have the substantial shareholding exemption that says, well, you sell a trading subsidiary you've owned for more than a year and you own more than 10%. That's pretty much it these days, isn't it?
No, it's worth explaining what that change was in 2011. When before that date, when a company left the group, the asset itself was deemed to be disposed of, and a charge to corporation tax on chargeable gains arose at that time.
In the company that's leaving.
In the company that's leaving. In 2011, what happened was that gain was added to the disposal proceeds of the company that was leaving the group.
Yeah, that's where I was getting there. there. And the point is, broadly, the substantial shareholding exemption now trumps those exit charges through the mechanism you've talked about. Now, that was great. It was very welcome at the time, but it only applied to capital gains tax exit charges. It didn't apply to the mirroring provisions that were introduced in the intangible assets regime that similarly said where an intangible asset moves intra-group, and that's tax-free, but you sell the recipient company within 6 years, you again have a deemed disposal at market value that will crystallise a gain, but not a capital gain, a gain under the intangible assets regime. And those gains, those exit charges, were not previously trumped by the substantial shareholding exemption. And it got a bit silly, didn't it? Because if we take an asset, and primarily we're talking about goodwill here, depending on when you started that business, if it was a pre-2002 business, the gain on the goodwill and any exit charge on the goodwill would still be dealt with under the capital gains tax regime. For businesses starting after that date, the exit charge would accrue under the intangible assets regime. So you could have two identical transactions, but in one case, no exit charge. In another case, just depending on when that business started, you would have an exit charge. And it was a bit of a bear trap, wasn't it? It was catching fairly innocent transactions and there was no great logic. A long explanation, all of which leading into the point that they have now aligned these rules to say, in the future, also exit charges arising under the intangible asset regime will similarly be trumped by the substantial shareholding rules. So draft legislation to follow, but that's our understanding as to how they will work. And again, clearly something we welcome and we look forward to the new rules in more detail. Fair summary, gentlemen?
Yeah,
yes.
I think the only surprising or slightly disappointing thing is it took 7 years to work out that there was an anomaly and to do something about it.
Yes, I mean, this has been pointed out for a long, long time, to be fair, hadn't it? And I think they always said there were technical reasons why they couldn't change it. But listen, they've done it now. We welcome it. Let's see the detailed legislation.
It would be a lot easier if we had a part 13 of the Corporation Taxes Act, Chapter 1, the banks, Chapter 2, Google and Facebook, and then not overcomplicate everything else with these fine distinctions.
But yeah, that's why we love it. That's why we love it. Okay, let's move on to one of my favourite topics. Just a quick point here. Research and development tax reliefs. So the headlines are there are some very generous tax breaks for companies undertaking cutting edge research and development. We in fact have two regimes, one for small or medium sized companies, pretty generous to be honest. You can have up to 500 employees in your worldwide group and still be small or medium. And there's a less generous regime for large companies. Now, if you are a small or medium sized company and you're undertaking R&D and you are loss making, you can claim a tax credit from HMRC, a nice fat check broadly equal to 1/3 of your qualifying R&D expenditure. When the regime was first introduced, there was a cap on that credit there. It was equal to the company's total PAYE and NIC payments to HMRC during that accounting period. That was abolished many a year ago. I can't remember quite when, but over probably about 8 years ago. So there was no cap on that credit by reference to the company's PAYE and NIC costs. HMRC's view is that relaxation was perhaps a little bit too generous, and they were giving tax credits to companies who arguably didn't deserve it and weren't employing staff and making contributions back to the UK tax system that way. So from 2020, it is proposed that the cap will be reintroduced, albeit this time at 3 times the claimant company's total PAYE and NIC contributions for the relevant year. HMRC say this will only affect about 5% of claimants, and again there is a consultation process that's going on where they will see if there are any anomalies or unfairness in this new change, and we will see. But this isn't going to affect companies until April 2020, and as long as you have a significant staff base in the UK, the staff don't have to be the ones actually doing the R&D, but just the company itself is making deductions under the PAYE regime, you should be okay. So watch this space. May catch a few companies who are genuinely doing R&D, but no immediate impact. It will only kick in from April 2020. So that's the one change on R&D, but pleased to say the regime continues at strength. Andrew, did you want to add something?
Expenditure incurred after April 2020.
Yes. So I think, again, we'll have to see the draft legislation, but I think periods that straddle that, there will be some sort of prorating there. Right, Doug's been sitting there very patiently. This is your big moment, Doug, okay? Come on now, bring it home. Finally, contracting and freelancing. Doug will reveal all here. I mean, reveal all the changes to the tax legislation. What's going on, Doug?
Okay, so there was very limited issues in the budget in respect of employment taxes. One of the things which I think was widely anticipated was the extension of the IR35 provisions and moving that from the public sector and extending that into the private sector. And that's exactly what happened. Although there is some good news, the extension is not taking place until April 2020. And there is further some good news in respect that the rules will not be relating to what is going to be defined as small businesses.
Do we know what we mean by small businesses, Doug?
Unfortunately, we don't. There is some interpretation either from the EU side or looking at the UK Companies Act. I think there is some possible interpretation that there might be relating to fewer than 50 employees, so therefore businesses will be exempt if they have under that number of staff. It's expected that there will be a further consultation period on exactly how things will be worked out over the course of the next year. And in addition to how the sort of status tool will actually be uprated to assist organisations with their decision making.
Okay, thank you. A comment from Mr. Wiscombe.
I'm just thinking, you've got an interesting circular analysis there. I mean, what happens? You've got a business, it's got 5,000 people, all of whom would be caught by IR35, if it applied to them, which would make it apply to them because they're no longer a small business. But if it doesn't apply to them, these people are interesting.
So get everyone off payroll as quickly as possible. It must be the solution.
I suspect somebody might have thought about that.
You heard it here first. Right, we have a final question from Jeffrey, just coming back to the R&D. He asks, what happens to R&D if a claimant company has no POI and NIC? Well, from 2020, the problem is they won't be entitled to an R&D tax credit. A payable credit, absolutely, Adrian. They will still be entitled to the 130% uplift. So they'll have the benefit of those losses going forward. But if they're loss making, unfortunately, as the rules stand at the moment, or as we're told they're going to apply, they won't be able to get any cash back from HMRC, I'm afraid. So that was that. So that was our tour through the budget. It's quite interesting just talking it all through. We keep saying good news. I think, would we say it was a giveaway budget?
You might, I wouldn't.
No.
That's a bit optimistic.
Yeah, but
could have been worse.
I think that's about as good as it gets. But I thank my learned panel for their erstwhile thoughts. I thank you all for joining us. We will be circulating the slides shortly, and we wish you all a very happy Christmas, a happy New Year. We'll be in touch in the new year, and we look forward to joining us again then. I always say, do give us your topics and suggestions for what we can cover. We've been doing these webinars for many a year now, and we're running out of ideas. So if you've any thoughts, please type them away now or drop us an email. So thank you for joining us, and we look forward to seeing you again soon. Bye-bye now.